Good evening, everyone. So, you've got, a bit like with the full Monty, you've got, although maybe that's not the most appropriate analogy, you've got me for one night only, one lecture only, on introduction to credit derivatives. Okay, it's just a single lecture. It used to be 3, as I'm fond of saying. I used to do one on pricing and structured credit products as well. But I think your credit derivatives pricing is covered elsewhere. So we'll just have an introduction of the product themselves, of the product itself, and some related issues, most notably the CDS basis, which I think is an important relative value indicator for everyone in the market to be aware of, okay, and to use appropriately. So my name is Morad Chowdhury. I have an academic affiliation there. Currently I do have a day job as well, but that's winding down. So the less said about that one, the better. And hopefully soon to resurface at a berth near yours in the next few months. In the meantime, I can speak freely with the academic affiliation. And the beauty of that is there's no compliance department necessary to sign it off. Right. So we're going to talk through for the next couple of hours or so on credit derivatives. If you have any questions at any time, usual score, please raise a hand and we'll go through it. I once did an undergrad lecture at, well, I continue to, actually, for my sins. Do my bit for community, really like. I did an undergrad lecture at Birkbeck, where I did, the connection is that's where I did my doctorate. And so it was a course on, it was a BSc in business and management. So they have a course on finance. They're not necessarily finance people. So I went and talked about debt valuation. 2 hours, 9 o'clock at night, it's the end of the evening, 2.5 hours. 60, 70 old people in the room. This lady puts her hand up and says, "I'm sorry, I didn't understand any of it." She was quite irate. And I said, "Yeah, I'm sorry to hear that. The problem is, of course, telling me that at the end of the lecture means I'm unable to address your problem, because we're all going home now, you see. So do raise your hand before or during rather than at the end." Okay, so let's push off then. Agenda. Today we want to talk about credit risk as a concept, credit derivatives as an instrument, use and applications thereof, the CDS asset swap basis, or the CDS basis, as I say, a liquidity value to be determined. When I say liquidity value, I mean the cost of funding term liquidity, which you can use the CDS asset swap basis as a proxy for. And then a few words on relative value trading. And there's a whole lot of appendices there which are there for your reference. I particularly like, that's a little biased, I particularly commend to you Appendix 1, CDS pricing from first principles. That's basically the Duffy Model for credit CDS pricing, which was published in '92. Darrell Duffy, a top man, close personal friend of mine. And I've basically put that in first principles, so it's an accessible description of how one would price CDS from first principles from market prices. Okay, so I recommend that to you if you're interested. But we won't go through it today. They're just appendices for your reference. Okay, so credit risk. Credit risk. Credit risk is actually the main risk that, and for many banks, the only risk, essentially, if you ignore operational risk. I don't think operational risk, we have a lot of tangents and asides in this lecture. Pull me back in if they last more than about 60 seconds. I don't think operational risk is peculiar to banks. Operational risk is something that every corporate entity would be exposed to. The risk of fraud, staff, ill behavior, conduct risk, so on and so forth. That's something that every bank, like every institution, is exposed to. But for most banks, I would say for the vast majority of banks, their main risk is credit risk. And the paradox there is most of the research output and the literature and the books on the bookshelf in the finance section of the large bookshop talk about market risk and derivatives, and only about 3% of the world's banks ever have any exposure to that and use them. But that's life. That's probably seen as the more snazzy part of the market. Credit risk is the main bread and butter of risk management for banks. And of course, what is it? It's the risk that your obligor, someone who has borrowed cash off you in some form or other, via, I've got their bond issuer, but it needn't be a bond issuer. It could be someone who's taken a mortgage off you, or a corporate loan. The risk that they will fail to service a debt repayment or simply not repay. And the risk of that happening means that the bank, the lending institution, is running this risk, which has to be mitigated in various ways. Okay, well, it doesn't have to be, but it's good practice to try and at least have a go at it. The likelihood of this happening is expressed by the default probability, okay, which has to be inferred from market prices. See the appendix. Yes? Actually, it's within Appendix 1. Or modeled using market or assumed parameters. It's also expressed in a sort of combined quantitative and qualitative fashion through the credit rating. So credit ratings, despite all the bad press and the court cases and the aggravation that credit rating agencies have suffered since the crash, the credit rating itself is still seen as vitally important and, something of note. Regulators use it. Then again, they also use value at risk to work out reg cap, and that in itself is a disaster. But credit ratings have a lot of importance still attached to them, so being aware of them is to be aware of the perceived credit risk. Funding costs associated with higher credit risk are expressed as a spread over a benchmark rate such as Libor or a risk-free rate at the government. A topical point nowadays is, of course, there is no such thing as the risk-free rate. So we can use something like Libor as a proxy for a benchmark rate. And here is a list of the credit ratings to give an idea of what the risk associated with different ratings is. So you have AAA, prime grade. So you should excise the word risk-free from AAA, which some people associate with AAA. It's not risk-free. It just means it's prime grade. Sounds like a cut of beef, really. Prime quality beef. And then all the way down to single C for the lowest rating, obviously D if it's in default, and so on and so forth. Okay?